Hello, this is Trading Algorithm. You're watching the first video in a series of tutorials on volume analysis. I'll start with the basics, the principles of pricing and stock matching. Most volume analysis algorithms are based on the logic of order placement and the price reaction to these events. Without understanding these basics, it will be difficult to build logical chains when looking for regularities and patterns that influence price behavior. Try to answer the question, what makes the price move? If you can't answer this question, this video will give you a basis for doing so. Traders' activity on the exchange leads to the conclusion of buy and sell transactions. When you click the buy or sell button, your order is sent to the exchange, executed and displayed in the print feed. The print feed is a table of impersonal trades that have already been executed on the exchange. On all advanced platforms, the print feed is available for analysis. The main fields that the print feed contains are the time of the trade, the price of the trade, the volume of the trade, and may also contain information about the best A, B and bid prices, open interest and other fields. Usually you will already see colored prints that correspond to the direction of the trades, red ones being market sales and blue ones being market buys. There are different types of market orders, such as market, limit or stop orders. And one of the important questions is what happens after you send a market order to buy or sell. Is it executed automatically or not? The answer is no. If you send a market buy order to the exchange is obliged to execute it immediately, but you need someone to sell to you. The flip side of a market buy is a limit sell order. These are placed on the order book. This means that for every market buy order, there is a limit sell order. If you sell in the market, you must be bought with a limit order. This is the basic principle of order matching. If one of the parties is absent, the trade does not take place. This begs the question, what happens if there is no limit seller for my market buy? First of all, remember that in the order book, sell limit orders are placed above the current price and buy limit orders are placed below the current price, as you can see in the example on the right. In this example, there are buyers in the order book, represented by the blue levels below the price, and sellers, represented by the red levels. The closest price level with limit sell orders is called best ask. The best buy price in the jar is called the best bid. Market orders hit these levels to execute a trade. So, if you send a market order to sell and there are no limit buy orders in the cup, the price will move down looking for buyers at the following price levels. Similarly, a downtick will occur if your market sell clears all available buy limit orders and the exchange sends the remaining sell order to lower price levels. The same will happen with market buys looking for limit sell orders. In other words, market orders by their very nature move the price up and down, clearing the queue for a buy order. The order that reaches the exchange first will be executed first. You may have heard the phrase, there are more sellers than buyers in the market, or vice versa, leading to a fall or rise. Technically, if we look at executed trades, the number of sellers is always equal to the number of buyers, because without one of the parties, the trade simply doesn't get executed and doesn't make it into the print feed. And the downward price movement is caused by the presence of market sell orders and the absence of limit orders to buy at the next price level. If there are more limit orders at a price level than market sell orders, the volume will increase but the price will not move to a new price level. In other words, limit orders, by their very nature, stop price movement. The superiority of market orders over limit orders creates a price imbalance. Otherwise, you will see a balanced market. Executed trades from the print feed are grouped into cluster candles, e.g. 5-minute candles as in this example. All trades executed in the 5-minute period are broken down into price levels and separately into a column with market sales and market buys. At the end you will see a familiar Japanese candlestick with opening, closing, high and low parameters. When you create your own indicator or algorithm with a pattern using candlesticks, you still use the data from the print tape. That's why everything is based on stock transactions. One of the most common questions is why there were more sellers in a candlestick, but the price went up. In the example, you can see the advantage of sellers over buyers at almost every price level of the cluster chart, but the candlestick is bullish. Logically, the price should have gone down. But the bottom line is that the market sellers were absorbed by a sufficient number of limit buy orders. At the same time, the buyers in the market were picking up the limit sales at the price level, causing the price to spike higher in search of new sellers. This is one of the principles on which I have built some of my indicators. Looking for such inconsistencies with standard logic can provide good entry points. Let's take as an example the extremes at which many traders set their stop losses. The exchange does not provide any information about stop losses, but we do have indirect evidence. This is a volatile candlestick, i.e. a candlestick that is visually much higher than its neighbors, and in cluster charts you can see many zeros at price levels. Stop losses are another type of order. When the price activates a stop order, it immediately becomes a market order by default. For example, if you have bought, your stop loss will be a sell stop order, which will turn into a market sell order. In fact, it will be a pending market order. In the example with the arrow on the right, you can see that after the blue extreme was broken, a volatile bearish candlestick appeared with many zeros in the middle. This means that the price was moving very fast and traders did not have time to place trades in the middle of this candlestick. This rapid movement was caused by the market selling and the lack of limit orders in the candlestick that would have executed the sales and stopped the price. And looking at the extreme we broke through, it is logical to assume that buyers' stop losses could have been behind it, as technical analysis teaches. Such empty zones within candlesticks are also called imbalance zones. And now I've highlighted two places on the chart where limit orders absorbed all market orders during the breakdown. Such patterns can be called liquidity absorption. As cluster candlesticks show the color of market transactions, in the first example, there is a surge of purchases executed at the same price on the breakout attempt from the previous HMA. This means that there were limit sellers on the opposite side who stopped the price from rising and absorbed all the demand. This absorption led to a reversal and a drop in price. At the break of support, a limit buyer absorbed all the supply, but the buyer was unable or unwilling to hold the price. The trend continued and a large cluster of selling can be seen below. The limit buying that absorbed these sales could have been take profits from sellers buying back their positions to sell. And the market selling that absorbed much of it could be stop losses from buyers who bought higher and are now selling their unprofitable purchase. Here are a few more examples of the typical behavior of stock orders when support levels are broken. The break of the first and second levels was accompanied by a large number of sell orders, with their advantage in the highlighted clusters being at least 2.5 times greater than that of the buy orders. The price was unbalanced and under pressure from selling, which drove the price higher. After the breakout candles, there are also candles with sales dominance and large sales volume nodes that were absorbed by the limit buyer, stopping the price. So at the moment we have found out the principle of order placement that leads to price imbalances in the print tape and that a sufficient number of limit orders stop the price movement, and we have seen signs of stop losses and liquidity absorption. You can look for all these cases in the print tape and candlesticks. Next I will talk about the indicators I have developed to look for patterns in the print tape. In the next video I will show you indicators that will help even novice traders to read the tape, identify logical patterns in the behavior of buyers and sellers, and predict further price action. Please support this video by reposting and liking it, writing a comment, it will help YouTube to promote this video. See you in the next video.